Good afternoon, everybody. Hope everybody had a great weekend. Well, let's jump in. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. I don't have any shorts on at the moment. A pretty big down move on Friday, and then today, between those 2 days, I got all out of the shorts for the moment. So I do have a bunch of long. I mean, I do have some UVixie calls a little bit still. I got a bunch of longs on. None of them are too heavy. I'm a little bit heavy in that VKTX, which got destroyed today and absolutely wrecked my P&L. But yeah. Besides that, I'm really like, it's a lot of longs, but it's not really much even beyond like my cash, which is pretty light for me. All right, so let's jump in. So the market is continuing to bounce here after hours, actually. So now we're only down 1.6%, but we closed 80 cents below this, so that's actually worse. And that's almost a $5 bounce from lows that were like 20 minutes ago. That's a very fast bounce back. Qs here are off 2%, and that's after a dollar bounce back since the close. Same deal with the Qs here. Really big bounce back off of that final low, like literally just 20 minutes ago. And the IWM closed down 2.5%. It's also 50 cents off lows. So I think this is more like a 3% down day in the IWM. So bottom line is, even with this bounce back in the last 15 minutes, it's continuing here after hours. The market got absolutely smoked today. TLT up a little bit, I think on just a flight to safety. And what's our dollar doing? The dollar is down again. So, I mean, yeah, market got absolutely thrashed. So we are continuing our short-term downtrend that we've started to develop here on the daily chart. I did not think for a minute this morning, and I'm not bullish. I think everyone knows that. I did not think for a minute this morning that we were going to break yesterday's low today. And in hindsight, that was probably an error. Just when you understand how close we are to the uncertainty, or now a little less uncertain, of tariffs being implemented tomorrow, it's just, I mean, it's just so bearish. I don't know how else to describe it. Tariffs are terrible. They're terrible for the economy. They're terrible for markets. You maybe could make some non-economic arguments for tariffs, such as national safety and things like that. But at least from an economic perspective, from a market perspective, tariffs are terrible, and therefore it's not a surprise that every single time we see the administration bring up tariffs, that the market gets hit. But I, like probably the whole rest of Wall Street, have really been thinking that these tariffs were not going to go through, or at least not go through anywhere near the extent in which the chatter has happened. So the market has done a good job up until now of kind of ignoring it. But all of a sudden, starting on Thursday, I guess it was, of last week, when they fast forwarded the 25% tariffs on Canada and Mexico and the additional 10% on China to Tuesday of this week, which is now tomorrow, all of a sudden the reality of the situation has started to hit this market a little bit more. And I actually still think that to some degree the market doesn't believe that this is going to happen, or that if it's going to happen, it's going to be a short-lived negotiation tactic. Because truly, if you were to implement 25%, full-on 25% tariffs on Mexico and Canada, and keep raising tariffs on China, and then put these tariffs on the EU, you will create a global recession, and this market is absolutely nowhere near to being done going down. But the whole thing that the market keeps pricing in, I really think, is that this is a negotiation tactic and that it's not going to fully happen. But all of a sudden, the fast forwarding of it to not allow for further a month of worth of additional negotiations, I think really was a bit of a reality call. And then it was the exact same deal today. The market was more or less holding in fine, throughout the day. We had a gap up this morning, which, not surprised that that gap up didn't hold because there's a gap up in this equilibrium zone. It's where we should be making a pivot high after a really strong snapback on Friday. But then, for the most part, we were trading down small, but hardly. When you consider how big the rally was in the last 15 minutes of the day on Friday, that we were trading within the range of the last 15 minutes of the day on Friday all the way until 1 o'clock, we were down very, very small. It was actually kind of a boring, choppy trading session. And then all of a sudden, we saw just further announcements and further rhetoric from the administration on tariffs. And then you see how the market reacts to it. We lost $10 here in the SPY in 45 minutes or so, all the way down to the huge 580 support level. So, we'll see what happens. But this market looks terrible to me. And I'm surprised, and I got caught a little bit more flat-footed today than I honestly should have. I did short some Palantir this morning, and Palantir short's my best name, and I did well with it. But I probably should have been more aggressive in reshorting the indexes. I wanted a little bit higher. I wanted a little bit higher on this QQQ to reshort the TQQQ. The high of the Qs is 513 spot 04. I wanted 513.50 to really begin to reshort. And being honest, I wouldn't have shorted a massive amount there. I would have shorted enough that it would have helped my P&L a little bit today. Obviously, even 100 shares would have helped my P&L. But I wanted a little bit of a bigger bounce back off of Friday's close to be able to really start reinitiating the shorts with more conviction. And just didn't quite get it on, and underestimated the ability, which was stupid of me, that we could trade lower further on the fact that tariffs might be hitting literally tomorrow. I think I was thrown off a bit by the Bitcoin stuff over the weekend. I thought that the Bitcoin stuff over the weekend and the amount that some of these crappy coins and Bitcoin itself was gapping up this morning could potentially reinvigorate a little bit of a short squeeze, just because the market had been so destroyed. And if you look at the data and statistics, especially like the growth stocks, the meme stocks, the most shorted stocks are the ones that have been hit really, really big these last 2 weeks. So seeing IBIT bounce back the way that it did, I thought actually might trigger a little bit of a short squeeze. Luckily for me, I was all out of my, well, maybe not because it traded all the way down, but I had gotten all out of my MSTR short last week. Had I still had that on, there's a good chance that I would have been getting squeezed off the open, and then maybe for some fund managers, a squeeze in one place can lead to a squeeze in another. So I think I was just thrown off a little bit by the bullishness of the Bitcoin announcement that came out over the weekend, that took away from the degree of gung-ho that I probably would have had to reshort in the equilibrium zone for the SPYs. SPYs into the gap up this morning perfectly between the 8 and 21 EMA, the IWM gapping up into the 8 EMA, the Qs, I know now it's touching, but that's because the 8 EMA came down because the market went down by so much. But the Qs at highs today, the 8 EMA was actually still above it. So, just trying to be a little bit patient because I didn't want to get caught in some sort of an opening squeeze that could come from growth. And it ended up hurting me because I just didn't have enough short on the books. I've got some long on the books. I'm trying to primarily focus longs where I feel like there is some degree of value and less on the growth side of things for the moment. But I do have that VKTX. That's my biggest position, and this basically gave bear flag continuation today. It was really, really nasty. By far my worst name, so that hit me fairly hard today. And I stopped myself out of this PGY, which I had initiated on a little bit of a fake out above this 1350 as a swing below Friday's pivot low. So I realized a decent loss on that PGY, which is fine. It's you got to manage your risk. And then on the energy side, where I do have some exposure because I feel like energy has the ability to be a little bit of a safe haven. Like if you guys remember in the calendar year of 2022, I think every single sector was down that year except for oil. They just have so much cash and make so much cash and have massive buybacks, and they trade it. Most of these XLE names trade at such relatively low multiples that it was a little bit of a safe haven back there. So I've been trying to, have some more value in what I do have long. But then when we got the announcement on the Saudis increasing supply, that really hit USO down, which further pushed the equity market down. And then I've got some exposure in the space, so that certainly didn't help me either. From a day trading perspective, I was able to make a couple dollars in Intel long in the morning, and I tried trading this Robinhood, and I traded it really well, but I didn't really make anything on it. I ended up actually pretty break even on it. Traded that to the long side, and I was looking for some bounce to come in, like off this low, and I got a little bit of a bounce, but I was looking for just a little bit more. I had a target of like 51.30, between 51.30 and 51.50 into like these up moves, and or into this up move. I couldn't really capture it, and then I got stopped out on this low right here, which in hindsight was fine because they ended up wrecking these names. And then that's like one of the bigger warnings I almost feel like this market is even giving today, is the way that they sold crypto back down. I mean, IBIT's bouncing a little bit here after hours, but this thing only closing up like 2% on the day. Hood closing negative. MSTR basically closing flat negative as well. I mean, this was... I know that there's still some uncertainty around specifically what Trump is going to do post that announcement that he made over the weekend about making the crypto reserve or whatever, and he said it's going to have Bitcoin and Ethereum and XRP and APA and Solana. I mean, that really should have been the announcement that these crypto enthusiasts were looking for, and it's crazy that MSTR couldn't recapture 300 on a closing basis on that announcement. It's crazy that they sold this IBIT and Bitcoin all the way down. But one of my favorite just technical themes on trading that I've been talking about for years is that when good news hits and you can't rally on it, it's a major warning signal. And the opposite is true also. When bad news hits and the market can't continue lower, which I remember we saw at certain points in 2022 in the last bear market, that becomes a signal for the other side as well. So the fact that they sold this crypto stuff back down, it just means that we are just in such a risk-off environment right now. People, they want cash. I don't know what they want. What did gold do today? Yeah, gold was able to be positive. They want cash. They want gold. They want some safety in consumer staples maybe. And there's just a lot of uncertainty there, especially with these looming tariffs that could cause some really serious economic damage. So we will see, what exactly happens with that. But I did not have a good P&L day today, which is what it is, coming off 2 really good weeks in a row. But definitely a little upset at myself for not being a little more gung-ho on the short side today, because that's really where my thought process has been, and it's just, in hindsight, at least seems so obvious with the tariff stuff. But like I said, I think some of the Bitcoin stuff threw me off. So the market looks terrible, but we did hold 580. 580 is a huge SPY level that we were talking about that level a lot back in the beginning of January. The market, it seems like the S&P always does a really good job benefiting from wherever the relative strength is. The SPYs always seem to hold in better even when the Qs are weaker. The SPYs benefit from rotation into equal weights and IWMs. When the Russell is trading worse, SPY benefits from the rotation into Mag 7 that we've seen. So some of these other indexes are really kind of well below their big levels, like 510. It's interesting that what we had been seeing back in like early January was 580 SPY was the equivalent of 580, right? 580 SPY was the equivalent of 510 QQQ, which was the equivalent of 218 IWM, and Qs are trading $12 below that hugely important level. The IWM is trading what did I say, 218, trading $9 below that hugely important level. And the SPY itself actually only tested it for the first time today, which is interesting, and held it with a lot of downside extension on multiple time frames into an important support level. So it's not surprising to see that we got a little bit of a bounce off that zone, because when we were trading at 580, we were $14 extended from the SPY 80 EMA, and at lows today for the Qs, we were where's the 80 EMA? 512.20 versus 598.60. We're basically $19 extended from the Qs, which we got to around, I don't remember exactly what the number was, 17, 18, 19 downside in the Qs at one point yesterday. And it's incredible that they were almost not extended at all at highs this morning. It's a huge intraday move. But when you start to get to those upper teens of extension in the Qs on the downside, that becomes some of the most downside extended that we have seen since COVID, and that includes the bear market in 2022. And the really interesting thing about it is that today was really only a day one. We had the price correction on Friday that was helped by the pension rebalancing on the buy side that came into the close to give us that really strong close. Follow through with the gap up this morning. They hit us with the tariff announcement, and we were able to immediately trade back down to $14 of extension in the SPYs and $19 of extension in the Qs. I mean, that's massive. But the crazy part is it's day one. So it's like that degree of extension is usually something that I want to buy. But I'm like, man, a day one off this tariff announcement becoming a reality, the flip side is that's very hard to buy. If it was a day three and we were now, tariffs had been implemented for 3 days, and it was a day three, and we were $19 extended in the Qs and $14 extended in the SPYs, that would be something that I would say is like a must buy for a short time frame bounce. But a day one, as the news is kind of re-breaking here for tomorrow, is something that you need to be pretty cautious with, and we'll see how we gap. Pat had it right when he was on the radio into the close that the ideal thing would have been a close on lows followed by a gap down for short-term trading opportunity, and we bounced well enough here off that low and well enough after the close that it kind of takes that opportunity away. So we'll see how we open tomorrow. Lot of volatility right now. So we'll see how we open. Maybe there's still a chance of a last-minute deal getting through, and that this all is a negotiating tactic, and we get a really big bounce back. But it's very hard to say, and we know that at a minimum, markets hate uncertainty, and this is just a huge looming degree of uncertainty, and therefore, the more uncertainty you have, the more difficult it is to own risk assets, and the weaker the market tends to trade. So, we'll continue to measure extension. I continue to not like, and you have to have trading rules, right? You have to have trading rules. And my trading rules dictated that into a gap up into equilibrium in a weak market is where you should be looking to short. So basically, this morning's gap up is where you should be looking to short. Short the indexes, again, which I didn't quite do. I wanted a little bit more in the Qs, or at least I got some Palantir short, which I ended up fully covering throughout the day. Could have been more aggressive there. But my rules also dictate that when we are $10 plus extending the SPYs, $10 plus extending the Qs, when short-term tactical is in the green, which it most likely will be for tomorrow, that I do not short, because you're set up with a bad risk reward at that point. You wait for the reset up. The reset up to short was this morning. So if we open up flat or down from where we're trading right now tomorrow, it's just really hard, because it's like that's not a good risk reward historically to short outside of just like a pure momentum day trade. You want to take a pure momentum day trade, and then maybe shit hits the fan so bad that momentum day trade really closes in the money for you and you can swing it. It's just a little bit of a different style of trading. It's not a wrong style of trading. It's just not really the way that I personally approach my own execution. I would almost rather, I can tell you, I would definitely rather, when I'm at those heavily large degrees of extension, come in on the other side and look for the longs than to press the short. And by the way, as terrible as this daily chart looks like in the market, the two occasions that we've had where we've had enough downside extension where it made sense to do that trade, both paid really well. One was back here on February 25th when we were on the day 3 to the downside and hitting that extreme extension for all 3 indexes when we got to lows. I was pretty proud of myself for how patient I was for coming on the other side. We were buying Amazon back through there. We were buying Meta that day on this like day 8 to the downside. That was a great trade. And then guess what? On Friday, when we gapped down, so it was like a day 2 gap down, and we were once again at extreme extension. We said during the day, in the morning meeting on Friday, that today is a day that you want to look, for the bounce back trade. Really more intraday. I was a little uncertain on how we would close because it was a Friday before a weekend, which creates with a lot of uncertainty. But we also knew that there was going to be a buy imbalance or rebalance, I should say, from pensions that could bounce the market back. So we ended up closing really strong. But within the confines of a market that's been absolutely garbage for the last, whatever it is, 7 trading sessions, we have nailed the 2 major longs just by understanding extension. So the opportunity to short was this morning. And, if we gap down to 580 tomorrow, could you get momentum down to 575, 574? Yes. But I would rather be looking to buy the 575 bounce back off of 575 than look for the short continuation of 580 when you just don't have a good risk reward, when you to add on shorts in extreme extension or add on shorts when short-term tactical is in the green is really just kind of against my trading rules. Maybe I would do it for like a cute day trade or something, but it's generally against my trading rules. And having those trading rules and following those trading rules really is key. And it's gotta help you sort through the noise a little bit sometimes also. So that's kind of where we're at technically. Back when SPYs were breaking all-time highs above 610, I said I was looking for a pullback to somewhere between SPY 580 and 570, which is where the 200-day is. We got to 580 today, but it doesn't feel like it's going to be the bottom of this move, at least not yet. But that's just the upper portion of the band that I was looking for, and that's what I called out when we're above 610. So, it's always an evolving thought process as the market gets to where you were expecting, and then figuring out whether or not there should be further continuation or not. But things just don't look good right now. They do not look good. So we'll see what type of continuation we potentially get. I think that pretty much covers everything that I have on my side. I am happy to take a look at whatever questions you guys have. Can we say that tariffs or no tariffs are what they are, and we should actually embrace the volatility? So yes, absolutely. We should embrace the market environment. A big part about trading is understanding the type of market environment that you're in, and trading, game plans and strategies that revolve around that market environment to maximize your profitability. So that could be an uptrend, it could be a downtrend, it could be a sideways or lack thereof trend. It could be increased volatility, it could be decreased volatility. So yeah, volatility tends to be good for us. It tends to create opportunity. It tends to create a higher risk, higher reward environment. It tends to make it so that as a trader, you want to be taking less size and more space risk. So that's the environment that we're in. Can we say that tariffs or no tariffs are what they are? I mean, sure, but for my approach to markets, it's a top-down approach. It's a macro to micro approach. I need to understand the big picture qualitative fundamentals in order for me to maximize my trading success. That's my approach. So tariffs or no tariffs, understanding the nuances of those tariffs and whether or not they're being implemented or not is something that is really important to me. And based on some of the things that you say in the VTF, you always seem to be, mentioning a whole bunch of macro things when you're talking about your consistent bear theses. So it seems like it's important to you as well. From Pete, what rules do you use to try to protect yourself on swing trades from gaps working against you the following day? Great question. So it depends a little bit on the trading strategy that I'm implementing, but a general rule that I have used and that I kind of preach is what I call my 1% rule for swings. And I call it the 1% rule, but I always like to say 1% may not be enough. You have to recognize the environment you're in. You have to recognize the stock that you're in. So basically, what that rule is um, when you are holding a position overnight, you never know what can happen overnight. You never can know with certainty how we're going to gap. You never can know with certainty what news is going to come out overnight that is going to actually impact the market. So when you're swinging a position, ideally you want to be swinging a position from a win-win position as much as possible, a win-win situation. So the rule that I like to utilize is what I call this 1% rule. And again, it's just what I call it. 1% might not be enough. But what I tell people is if you're thinking about swinging it, obviously you want to analyze your macro, daily chart technicals, and things like that. But are you at least 1% in the money on the position? If you are keeping a position overnight that you are in the money on, let's just say 1%, and then the whole market gap's down by 1% tomorrow. Are you screwed? No, you're fine. You're probably not happy to give back your P&L, but all that's happening is you're giving back the open profit that you still had on the position. So then you're stopping yourself out that next morning because the entire market gap down. You probably made money on that because most likely you already booked some profit intraday yesterday into the move. It gaps against you. You give back your remaining open profit. You stop yourself out. No harm, no foul. What you did was you put yourself in the position to make even more money because maybe the market gaps up 1% tomorrow and your trade just continues in your favor. So you put yourself in the position to make even more money by risking the money that you have primarily already made. That's what I love to do. What I do not like, what I'm not an advocate for, is you have a position that closes against you, and then you're like, you know what, I'm going to swing this position because I want to make my money back. What you are doing in that situation is you're taking unlimited risk for zero reward. You're like, yes, the second that this thing gets back to my entry price or my P&L is at zero, I will liquidate the position. So that's if it gaps in your favor. But if it gaps against you, you're just totally screwed. So in one situation where you're swinging positions that are already in the money in your favor, you're putting yourself in generally a win-win situation. Either you give back the profit that you've made or you make even more. Or the other situation is you hold something that is break even on your day, or you hold something that is even worse, it's against you. And then if it gaps in your favor, you're just making your loss back. If it gaps against you, then you're totally screwed. So now then you're basically taking unlimited risk for zero reward. Now, in the positive situation, is there a situation where you have a 1% profit cushion and the stock gap's 2.5% against you and you're still not in a good spot? Yes, but by giving yourself that cushion, you mitigate that. And that's also why I say sometimes 1% may not be enough. You have to understand the volatility of the stock that you're trading, the market that you're involved in, and maybe an environment like what we have right now where we're moving percentage points every day recently. Maybe a 1% cushion is not enough to actually swing something. Maybe in this environment you actually want 2 or 2.5%. And then there's still a possibility, though it's fairly rare, it has happened to me, that you get bad news in your individual stock get overnight and the stock gap's down 10%. And that sucks. It's happened to me. It sucks. But generally, I am an advocate of swing trading. I think if you utilize swing trading right, it is a way to increase reward while further minimizing risk and increase the risk-reward ratios in a positive way of the trades that you're putting on, provided that you do it properly. For your second question, for engulfing candles, do you consider satisfied the engulfing if is versus just the body of the previous candle, or do you want to see it engulf the complete candle, including the wicks? The complete candle. So most of the time, there's not much of a wick on it. But if you want to use Thursday of last week as an example, I mentioned in the morning meeting today Thursday's high, because Thursday's high would if you got above Thursday's high, which is 598.02, you would fully negate this candle, and then that would be bullish, because that means that every single person that sold on this candle, this wide-ranging candle, was wrong, and it actually makes it easier for the market to move higher. So the main short-term spots I mentioned in the morning meeting was that 598 and also this pivot high from Wednesday, which is 599 spot 58, but I really just rounded up to 600. Third question, on your training videos, you address quickness and execution. How do you quickly cancel convert your stop in a name that you can immediately get out of the position on news? I find that I am too slow finding the stop, canceling it, and then putting in a new order to sell. Sure. So, one thing is you certainly want to understand the platform that you're on. At T3 as a whole bunch of different platforms are offered, and they all have their different upsides and downsides to them. So, what I might say about the software that I use, which is Lightspeed, may or may not apply in the same way for whatever software you're on. For the way that I trade, I primarily am using hotkeys for everything I do, and I can be very, very quick with them. The one area where I'm a little bit slow is canceling orders, whether it's canceling a limit order or canceling a stop, because I actually have to find that limit order in my orders window, and I typically have 300 to 500 limit orders at a given point. I have to find that limit order or that stop within a slew of 500 orders. But I have the ability to sort my orders in alphabetical order. So if I know that I want to cancel an order in Unity, in symbol U, I might just sort by symbol, and then I know my alphabet, so U should be towards the bottom of the stocks that I'm in. And then now, all right, now I've just got my 20 orders for Unity, and then I can, find that one order and cancel it. So I can do it relatively quickly. There's definitely a little bit of a delay there with that, but for the most part, just using hotkeys, I can do things really quickly. And then I was gonna make one other point about the question, and I don't remember what it was. Let me reread the question. How do you quickly cancel your stop? Oh, in a name so that you can immediately get out of the position on news. So I am, and I don't know if your software has this ability or setting, but if I wanted to quickly exit the position, if I were to do an order that fully liquidates the position, it cancels that order automatically cancels all my other orders in the name. So maybe again I'm long Unity and I've got 8 bids and 8 offers and a stop loss out in it. So 17 different orders. If I just press my market sell button on Unity, it's going to liquidate my position, and every single open order I have is going to automatically cancel. The final thing that I would say is I don't like the idea of canceling or converting a stop because news comes out. I am a big believer in buy the ticket, take the ride. So if I have a trade on and I have a game plan for that trade, and that game plan includes a stop loss, and a new event occurs like new news or the technicals look worse or whatever, I don't change anything. I don't liquidate the position. I would rather take more of a loss by letting it get all the way down to my stop loss and following my original game plan than take less of a loss by changing my game plan and liquidating the position on the fly. And there's a reason behind that. In theory, that sounds crazy. Why would you want to lose more money in a situation when you could save yourself some money in a situation? And it's because I am not a perfect trader. I have never met a perfect trader. And I find that when we are in trades, we become very subjective on the trade. And you can overly focus on one piece of perceived news or one 5-minute candle or something, and if you show me any trade, I promise you I could find one reason why that trade will fail. But maybe there's 100 reasons why that trade will work. But as traders, when we are trading in the moment and the P&L is moving and everything else, it can become easy to focus on the one reason why that trade should fail and totally forget about the 100 reasons why it should work. So I'm a big believer that when you get into a trade, you create a game plan for yourself, and that you should follow that game plan, and that even when there's a rare occurrence that you could save yourself a few dollars by stopping yourself out early because either the technicals don't look good or some news hit or something like that, I'm going to say 99 times out of 100, I don't want to do it. I want to let the stop cancel. I want to take the full loss, and I want to be disciplined with the rules and the game plans that I have that actually enable consistent success. Question number 4 or 5, I forget, from Pete here. On big gap earnings or news, how do you control risk reward as will have moved considerably from your out price? Let's say bullish, how much are you willing to pay up, etc., and where do you put your stop? I'm struggling to understand if the question is asking you're already in the position and then you get a huge gap from earnings or news, or you were not in any position, you were flat, and then there was earnings or news and there's a huge gap up or gap down, and then you're trading it. So I'm struggling to understand which one of those scenarios the question is asking, but I guess I could probably just kind of answer both. So the first thing I would say is you probably shouldn't be holding stock in earnings. If you are holding stock into an earnings report or into a news event that you know is going to occur, you are 100% gambling, and you should not do that. I do still occasionally do that, with that said. I do that going back to what I was saying earlier about gaps, like the 1% rule. If it's an earnings name, I kind of more have like a 10% rule, or sometimes double the options expected move. If the options expected move is $5 for this stock, and I have a swing position on that's $10 in the money, I'll probably keep it, because there's a good chance it could gap down $5 against me. There's a lesser chance, but it's possible that it could gap $7 to $10 against me. But even in that rare situation where I get a move against me that is double the expected move of the earnings report, all I'm doing is giving stock back. So it goes back to exactly what we were talking about before. But the flip side is if that moves in my favor, it enables me to further maximize risk. Further maximize reward or risk reward. So that's that. And then if the question is, and this is based on your follow-up, this is what the real question was, if you were flat the position and reported earnings or had big news or whatever, and it's having a big gap up or a big gap down, it's very much dependent on the situation, to be honest. The main thing that I look for initially on any news when I'm doing my research early in the morning, because we start getting all the earnings reports and upgrades and downgrades and everything into the VTF, usually starting at like 7:30 in the morning or so. The first thing that I look at is the daily chart, and I look for daily chart levels. And if a stock is gapping, I don't have any good examples from this morning, but if a stock is like gapping up into an area that I think is irrelevant on the daily chart, like there was a lot of previous price, like I don't know, I just got the SPY chart up right now. The SPY chart, the SPYs have been in a range, and we could just pretend it's a stock for a moment. The SPYs have been in a range between 580 and 610 since November. 1, 2, 3, for 4 months. We've been in a range between 580 and 610. If tonight SPY had an earnings report, because we're assuming it's a stock for a second, and it gapped up to 595, that'd be a $10 gap up. I can tell you what I'm doing with the stock is absolutely nothing. I'm looking at the daily chart in the morning, and I'm typing up the next daily chart, because I have zero interest in trading an earnings name that's gapping to no nearby levels, that's gapping to the mid part of a range, that's gapping to where there's a lot of price congestion because stocks don't move as easily. If you were to show me now it's the same SPY stock reports earnings tonight, we know 580 is a huge level. It gaps down to 577. There's a good chance I'm looking to short versus 580, because now it's trading outside of the range. It's trading to a really important area. It's gapping below it. It's potentially what we call a breakaway gap to the downside. That's something that I'm willing to trade, but I'm primarily looking at the daily level. So my general thought process when I'm looking at a pre-market is going to be short versus 580, because 580 is the big level, and it's trading at 577. I've got potentially $3 of risk if I take it right there. Or sometimes if something's gapping up too big, like Robinhood is an example today. Actually, here is an example. I was interested in going long Robinhood versus like 52.50 to 53 based on my research in the morning meeting, which included understanding the relevant news of Robinhood. It had some sort of analyst, I don't remember, news. I don't remember if it was an upgrade or if it was just a reiteration, but it was positive. And it obviously was being positively impacted by the Donald Trump announcement over the weekend on crypto. But I'm not 55 versus 52.50 is more than I was willing to pay up. But I start by knowing the daily level, and then I break it down to the small time frame. So like a trade that I like, and this did not happen here at all with earnings names, is when you get a really, really big gap. Oh, this just happened in I think it was I. Was it I? Yes. I traded this I last week. This is exactly, I love this setup. It was on this day here. It was on Wednesday last week. So I gapped up really big on earnings. One of my favorite trades on an earnings report when you get a really big gap, and I'm always going to be looking at this in conjunction with the daily chart, in conjunction with the daily levels. But I love, like, if I love, let's say that based on the daily chart, I'm not going to bother to analyze the daily chart, that 12 quarter was a really important level. So what I'm doing in the morning meeting is I'm going, okay, I had earnings, it's gapping up to, pre-market is trading at 13.75, 12 quarter is a really important level, so I write that down, and maybe it's a breakaway gap to the upside, and I'm like, all right, I could potentially big picture look to be long versus 12 quarter. Am I willing to buy 13.75 versus 12 quarter? Maybe, but probably not. A $1.50 risk in a $13 stock is a lot for day or swing trading, right? So it's probably not a good risk reward. But I'm starting with the big picture, and then I'm breaking it down to the small picture. So I know that as long as I is holding above 12 quarter, that's bullish, and I'd be interested in potentially getting involved if I find an opportunity. And maybe that opportunity is I'm just going long versus 12 quarter, or maybe I get an intraday setup knowing the big picture. So one of my favorite trades on earnings reports, when you get that big gap, is to trade a pivot on the first test of the 80 MA on the 5. It's a really good trade. It works a lot. It's a really good risk reward when it does work. And it's basically this stock, extension rules still apply, right? Even in earnings names, even in news names. Though in an earnings or a news name, there is a higher probability of momentum continuation because you tend to see momentum when there is news. One of my favorite trades is getting that technical pullback to that first test of the 80 MA on the 5 minute, so there's no longer any extension on a 5-minute chart, and then seeing a pivot low in a bullish scenario, some sort of downside tail, or in this case, gave a downside tail followed by an inside 5 and up, and then looking to be long versus that low, basically after the tail comes in. I'm not buying, this is important, I'm not buying versus the squiggly line. I am using the squiggly line to understand equilibrium, and I'm buying the candlestick setup of the downside tail into the upper band of equilibrium. It pierces right through it, gives you the downside tail. This is the trade I took on that Wednesday. I went long versus low, and I caught this bounce back move for profit. So that's a trade that I really like on earnings when you get those really big gaps. But a lot of times, if I go through 20 earnings stocks in a morning, as part of my research, I might find 1 or 2 potential trades I'm even interested in, and then there's like a decent chance I don't even trade either of them. Maybe I trade one of them, maybe I don't trade either of them. It's like I think I mentioned this earlier today. It's that breakdown of, and this is why trading requires a lot of work. Starting with a big picture of all of this potential opportunity stemming from 3,000 listed equities. Well, I'm not interested in all 3,000 listed equities, but I'm interested in the ones that I think are consistently important, like the Mag 7 stocks. I'm interested in anyone that potentially has news. So, I'm not reviewing 3,000 stocks every morning, but I might be reviewing 25 to 75 that are the names I look at regularly or names that had news, and then of that hard work of looking at 75 stocks, maybe I find 5 to 10 opportunities that I'm interested in, And maybe of the 5 to 10 opportunities that I'm interested in, I trade 1 to 3 of them. And that's the breakdown of being selective to try to find good names and good opportunities that can actually pay. Um, so I think that answers the question on that. And then I guess your final question: do you pay much attention when the 80 EMA crosses 21 EMA? No, not really. I won't say that I pay zero attention, but I don't necessarily care about moving average crossovers. But I recognize that moving average crossovers are a part of a reversal process for that time frame. So I don't execute ever on a moving average crossover, but I recognize the information that is coming from a moving average crossover in regards to potential trend changes. Thank you for the questions. From Eli, in a headline-driven market, do you adjust the way you swing names? We can see these names all getting hit into the close, but then something comes out in the AM before the market open that states there will be a delay in tariffs. Just, yeah, and then we, not impossible for there to be an announcement tomorrow pre-market that says that we're delaying the tariffs because Trump had a great conversation with his friend Xi and his friend Trudeau and his friend in Mexico, and we get a big gap up. I mean, that's just the environment that we're in. I don't necessarily do much different. I think it just circles back to the question that Peter asked earlier when I was talking about swing positions from a win-win situation. I just think that in this environment, when it's still a good idea to swing, but you might need a larger cushion on your swing in order to keep it overnight than you would have originally. And then what's going to end up happening, just generally speaking, more often, is that you are going to have swings where you get news that moves in your favor, and that'll benefit you, and swings that are going to gap against you because the news was against you. There's no way that you can control that. I like to think that in the long run it evens out, unless you're Rex, in which case it always gaps against you. A little inside joke there. Tomorrow's news will be yeah. So we'll see on Mexico, China, and Canada how they respond. I'm pretty sure that Canada already said that Trudeau already said that they're ready to implement 25% tariffs. From Pete, on the candles, my computer power surged for a minute. Did you say you can look for it to include wicks? Yes, include wicks. And also, just so you know, if you ever miss an afternoon meeting or miss something from the afternoon meeting, they're all recorded on YouTube and you can go back and watch them. My system won't let me sell at the market if I have limits or stops in, so I have to cancel them first. Yeah, I mean, I would just confirm that by reaching out to the trade support team or reaching out to Pat, who can look into the ins and outs of your particular software. I know you're on DAS. They could reach out to DAS on your behalf, or I think Bill here has mentioned that there might even be an internal system within DAS itself where you can reach out to DAS's support instead of T3's. I don't know what's better, or you can do both. Cool. Looks like I got everything on the VTF on the YouTube. What are you thinking for this week? More follow through to the downside. Yeah, generally speaking, this market doesn't look like it's done going lower unless we can negate some of these negative Maribozus. You need to get above today's high. Unless we can get above today's high, the market looks like it's going to continue down. But it's like I was saying earlier, we also need to think about downside continuation within the context of extension. Just because we may get, let's say even if we, let's say I could promise, which I can't, that we're going to get downside continuation to 570. That still might not mean that shorting 580 is a good idea, in my opinion, because maybe we get. I promise you that by the end of March we will get to 570. And again, I don't actually promise that, but let's say I could. Well, tomorrow we open at 580. Should you take your life savings on leverage and short the market because I guaranteed you that it's going to go to 570? No, it doesn't mean it's good risk reward. by the time we get there, maybe on the last day of March, we bounce back to 605 first, and you're bankrupt, and you had to blow out of all the positions because you were getting margin calls and everything else. So, it's about trend analysis, expectations of whether or not we can get continuation, but also doing it within the confines of understanding extension, which helps us understand the risk reward of putting those trades on. From Apex Joy, when will you start to add swing longs, or have you added some already? I have very small, but I don't have the conviction on it. The real question you should be asking is, when will I have conviction to add to swing longs? And I'm not 100% sure until it happens, would be the first thing I would say. One thing that would give me conviction on new swing longs is if I saw that positioning got completely washed out. We're not there. From what I've seen, all we've done in this market pullback so far is bring positioning from a very, very elevated position, from CTAs and long short funds and retail, to like a little bit more of a normal neutral area. We are by no means anywhere near being washed out from a long positioning perspective, where you get to that point where you wonder to yourself, well, who's left to sell, right? In the exact same way, when we were at all-time highs here on February 19th, one of the questions I was asking was, well, who's left to buy? There was a couple cohorts that actually still could have done a little bit of buying up there, but I'm asking myself, who's left to buy? Not the long short funds, not retail. They're all maxed out. CTAs are getting close to maxed out. When I can ask myself that question on the opposite side, who's left to sell? CTAs are washed. All control is washed. Long short is washed. Retail is washed. And we're $20 extended from the ADMA on the daily. That would be a situation where I would be buying long swings, but not just for a bounce back to the ADMA on the daily. For more of like a October 2023 bottom. That situation often does not happen. Oftentimes you get a bottom without having to necessarily fully wash out positioning. It's just that would create very, very high levels of conviction if you could kind of create that perfect scenario. But again, most of the time the perfect scenario does not occur. So until then, it's like, all right, when we get the extreme downside extension on those day threes, I will be looking to buy for day trades, for some tactical long swings, and then maybe my retracement turns into a reversal, and I kind of take it day by day. But I'm very nervous about the macro environment right now, and the nervousness is moving from inflation scare from tariffs to growth scare. So I'm in no rush to do a lot of sizable big picture buying. I actually would like to have a little. I don't have like a lot on from like a cash leverage ratio on right now compared to me historically, and I actually wish I had a little bit less. But I got to follow the game plans for the positions that I'm already in, so I don't just allow myself to liquidate them, and I don't allow myself just to liquidate them into downside extension. Kid Poker is wondering why NQ rallied 200 points after the close. Yeah, I have no idea why. Could just be a continuation of the oversold bounce that happened starting with 15 minutes left. But otherwise, I didn't see anything new. All right. I got through all the questions everywhere. I'm going to wrap it up there. Have a wonderful night, everybody, and I will see you all tomorrow.